Hey, it's Scott here from Scott Phillips Trading. I just wanted to go over quickly all the things that have gone on in the markets today. We got some fascinating setups. Now, the most interesting thing is that we should have seen a bounce yesterday. And the reason we should have seen a bounce is look at these lower wicks. These are 1, 2, 3, 4. These are failed attempts to drive the market down. After the market is attempting to bounce 4 times, it really should bounce, whether or not it gets to the old highs or not. But what we saw is that today, look at this, not any kind of attempt to make any kind of bounce at all, gap down and fail bad. Breaking the lows of the day, this is an epic fail by the bulls. And it's coinciding with all that tariff talk nonsense. So this sets up the stage for a further decline. Now, if we look at the rally from the lows to the highs, really a 50% pullback takes us to this zone. I think that's probably a reasonable place to start thinking about it. I would not be knife catching this market yet. I'd wait for a clear sign of a bottom before getting long. Now, that day's candle is open near the highs, close near the lows, expanded range. So what's that telling us is that the market is weak. The bears controlled the open and the bears controlled the close, and the bears had it on lockdown all day. That was a clear kill shot victory to the bears and at quite an inflection point. And it's more significant because it happened at a point where the bulls should have been strong. So the bulls woulda, shoulda, coulda been strong, but they were actually weak. All right, moving on. We have a really cool setup. Euro US dollar. We have an arguable breakdown from this trading range. It seems to be making a series of lower highs, and this is a nice spot to get positioned short. How do you play it? You don't just jump in short, you wait for a break of this low, place your stop here, and we're targeting new lows. So well under here, I would take some partial profits here in case it's a double bottom. We have the same setup in the US dollar. So this is a price action setup called a retest variation buy. You wait until price breaks the high here and place your stop loss here. This is arguably a little better than the Euro US dollar. Now, yesterday I posted GBP USD to my mailing list, which you would have got. Set to go short here, stop loss here, and that's working fine so far. The big news overnight is in gold, which I'm already long, and I'm long from the break of this high, stop loss here, and it just jacked up overnight. Now, whenever you see one market leading the way in a complex, we've got a whole bunch of other metals that are related to it. So let's look at silver. This is July silver, or you could use the SLV ETF. And we have a very compelling bottoming pattern here. So how do you play this? On a break of the high, we get long, stop loss here. So we have a very tight risk, enormous risk to reward here. And if we change this to a continuous contract and look at it on a weekly basis, you can see that we have a market which is trying to find a bottom. Now, it is not safe to bottom pick and try and get long here. This is not safe at all. On a longer time frame basis, this is a weekly chart, so this is really a big picture retest of these lows. So if we look at it on a monthly basis, it looks like this. We have a significant low, the lowest low in 10 bars. We have a number of higher closes and lower closes, and if we break up here, we could very well shoot past there. This is the very definition of an outstanding risk-reward setup, and I will be taking this one. It also appears in platinum. Let's look at it back on a daily basis. So we go long here, same basic thing. So you can't take silver and platinum and gold all together. That's nonsense. That's silly. We go long if we break here, stop loss here, tight stop, targeting at least fresh highs and another leg up. Okay, guys, if you want more, I'll be back tomorrow.